You have a truly global business at EY. I mean, and you are dealing not just on your own behalf, but on behalf of clients around the world, C-suites. Give us a sense from the C-suite, from your clients, how concerned are they about the U.S. China trade problem?
It's a big issue, David, but I think people looking longer term and businesses who have to look long term, make investments today that'll bring dividends way down the road, have to look past every tweet and every speech and every individual comment and look to see whether there's progress. And on the downside, we've seen the state-owned enterprises grow at the expense of private investment for the first time in 20 years. So we are seeing more recognition that China is slowing, which is not good for the global economy, and that's a big issue overall, and that the government stepping in to beef back up investment, undoing some of the reforms. That's not a positive.
And what about the supply chain? Are you seeing companies start to reroute their supply chain to go around some of the trade problems that we have or anticipate?
I think people are most of our clients are looking at backing up their supply chain. It's a little early to reroute and completely change your trade routes or investment routes for the longer term right now. The U.S. tax reform is going to cause a lot of shifts in supply chains over time. But right now, I think you're seeing more backing up. It takes a while to start to change your supply chain.
So, Professor Slaughter, I'd love to get your take on this, given all of the work that you've done on globalization and how it has failed on a number of different issues, or perhaps we're seeing some of the challenges now. Are we seeing an unraveling of it? Are we going to see sort of a backtracking? Can that happen?
Well, as Mark says, slowing growth in China isn't great for globalization in the sense that China's fast economic growth has spurred a lot of cross-border investment. It's been a support for immigration in some ways. So slowing growth in China is something that really matters. I think that ongoing trade war between the U.S. and China makes clear that in the United States and a lot of other advanced countries, though China's accession to the global economy has been great overall for China and for many countries like the United States on average, it hasn't benefited every single worker and firm and community. And so how the domestic politics in China and in the United States play out with this trade war is going to be a very important question for what resolution hopefully there is in 2019 to this trade war, but we'll see.
So Mark, this reminds me of the fact that business is not all about business. There are other factors, such as globalization, such as populism we see. You have a new venture actually called EPIC. Involving the embankment, I guess in London, basically, is the name. But explain what EPIC is to try to really codify some of the other intangible factors that can affect the success of a business.
Well, so thank you for asking about it. So EPIC is pulling together asset owners, asset managers, and corporations, David. And what we're trying to do is say, we know that quarterly reporting, short-term focus, like you're seeing in the stock market gyrations today, isn't really what every investor should be watching. They should be looking at whether or not, over the long term, corporations are returning value, minimizing risk, and creating opportunity to grow. And so today, we look at purely financials and short-term financials, and that's not what the investors need or want. Most asset investors, owners want to offset their long-term liabilities with long-term investment, not short-term. So this is trying to say, what are the long-term value drivers that businesses really look at? And it brought these asset owners, managers, and corporates together to try and identify the 4 or 5 biggest areas that provide for long-term value. And then how do you actually measure that, which is harder because with financials, it's very easy to look at numbers. But when you talk about talent, innovation, governance, and societal impact, which are very important to long-term investing, how do you measure those things? This group was aimed at coming up with some metrics for that.
Dean Slaughter, I have to think about some of these initiatives that Mark Weinberger and others are talking about, a way to try to make the economy better and push it forward and create more innovation. How much does a possible economic slowdown stymie those efforts? Because I'm looking right now at manufacturing globally. The U.S. is the only bright spot. Otherwise, it's turning down, and we are seeing signs of a slowdown.
Yeah, great question. One of the biggest concerns, I think, is those long-term investments that this EPIC initiative seems to be focusing on. Those are investments that ideally firms sustain quarter across quarter, year across year, because it builds their sustainable competitive advantage. So investment in early-stage research and development in companies, in the talent for their people, those are the things that tend to generate sustainable returns for the investors and the broader stakeholders in companies. And consistent with that initiative, one of the things that's really interesting is we should all keep in mind the number of publicly traded companies in the United States has fallen by about half over the past generation. So where we see innovation happening in the economy in America, it's important to not forget the private capital markets. It's important not to forget entrepreneurial activity and where that might be growing. The decline in dynamism in the U.S. economy has been a challenge. And so these initiatives like EPIC, I think, help companies think more broadly about how they sustain competitive growth.
Mark, you mentioned measuring. Back when I was running things, we used to say if you can't measure it, you can't manage it. And that was certainly my experience. Yeah. How do you measure it? Because you don't have general accepted accounting principles that apply to the things you're talking about.
Great point, David. And Matthew, by the way, is spot on, as he always is. I mean, this is, if you look long term, I mean, the average life of an S&P 500 company 20 years ago was 33 years. It's down to between 15 and 20 years today. So if you're not watching these things, the chance of you not being here in the future is increasing. So it is important to measure, though. It's trust but verify. You need KPIs to go against your long-term strategy. The difference today, David, than when many, many years ago, with all the data that's out there in technology, you can actually assess culture. You can actually assess your engagement of your people for talent. And we actually, every year, I call around to all of our managers, and I ask them about their engagement scores. And we can now correlate engagement scores to retention, margin, and overall revenue. That's a very positive correlation. That's how we need to run a business that's based on 270,000 people around the world. So these issues are actually much more measurable today. We have the data to be able to do it, technology to do it, and we can now, the real point will be whether we could standardize it across industries. In the 1970s, when everybody was reporting financials before we had standard accounting, everybody just reported whatever they want. Today, that's what's happening in the non-financials. We're trying to standardize those ideas and how to measure them.
You know, it's really interesting to me. Dean Slaughter was mentioning how there is an increasing number of private companies and that the number of public companies in the U.S. is shrinking. Do you think that there is going to be more fraud and more sort of financial malfeasance that erupts from some of these companies that don't comply with public standards, but that have gotten, billions and billions of dollars over the past decade?
Well, I'm not sure I jump right to fraud. I think,
well, no, but I mean, the reason why I ask that is because typically at this point in the cycle is when you start to see some of the, I don't know about fraud, but financial shenanigans or massaging.
What I would do, Lisa, I would go more towards risk. I think what you're going to see is there's not a lot of liquidity demands that big banks have to have on some of the private equities and private market money. They're not as much oversight from a regulatory standpoint as to where they're investing, what they're doing to protect the investor. So I think you're going to have greater risk as they move up the yield curves to get higher returns, and they're looking very hard to take that excess capital, that dry powder that's sitting out there, and invest it. I think they're more increased risk and more chance of maybe fraud or malfeasance.
Matthew, from what you said, it sounds like you certainly are open to the sort of thing that Epic is doing here. What role, if any, does the government have? I mean, at some point, should the SEC require disclosure of some of these numbers in their regular filings, for example?
Well, whatever the structure for companies, having transparent information to their investors and broader stakeholders is always important. So having the SEC and other federal government regulators be on top of the nature of how our companies and their business structure is evolving is really important. I can't emphasize enough, though, one of the things we hear, as Dean at Tuck, I will say the companies with whom we have great recruiting relationships, EY being one of them, how many of them say the scarcest talent they're seeking right now in our MBA candidates and great colleagues more generally is individuals who can articulate and defend points of view in environments of disruptive ambiguity that we've been talking about so much here. And I think I'll take it all the way back to the Fed. What matters for the long-term growth of the U.S., for China, for the global economy overall, is what kind of innovation these companies can really create that's sustainable and it's going to create new jobs and new businesses. The Fed tries to support that. SEC and other regulators try to support it, but that's the most fundamental challenge that faces a lot of businesses and more generally countries like the U.S.
Can I just say, and Matt, we love your students, so yes, thank you. Please keep giving them to us.
There you go.
And I would say, we had at the conference we had with Laidlaw & Rothschild, the Coalition on Inclusive Capitalism, where we talked about and unrolled Epic, we had the chairman of the SEC there, and we talked about this issue about what they're looking at, and they absolutely get it. And right now they're looking at, certainly, as you heard, looking at quarterly reporting and determining whether that's appropriate. Certainly the reporting's right. Quarterly guidance is more the issue than quarterly reporting. You do need transparency, but they're also looking at talent as a particular issue. It's not about more reporting, it's about reporting on things that matter more. And they're looking to see what you can do to try and come up with some standards or at least recommendations to be able to have businesses report on those things. I think that's what we're going to be seeing focus on from regulators as well.